Thank you very much, Renee, and good afternoon to you all. I think we're now just about ready to bring up the panel, the first panel that is, and we're going to talk about some of these kind of mega trends and mega themes that investors should be looking at. So, if you could, a round of applause, please, for Junbei Liu of Tribeca, HUGH GIDDY of Investors Mutual, or IML, and KIRSTY MACKAY-FISHER of WaveStone. You can all grab your microphones there as well. And thank you all very much for keeping me company up here, otherwise I'd be talking to myself, which I greatly appreciate. So we're going to cover kind of four main megatrends here, if you like: economic regime change, AI and digital innovation, public versus private markets, and aging population. So let's start with the economic regime change, and Hugh, I'm going to throw you the first question if I can. And we'll start with the big economic regime change, especially the last few years certainly, and that's inflation. So Hugh, what do you think the outlook for Australia is, especially when it comes to inflation, and how has it been impacting the way you assess companies?
Thank you everybody for coming, and yes, inflation, an interesting topic. I think we live in a paradigm where free markets are a thing of the past almost, and one of the biggest sources of intervention is government policy, central bank intervention on interest rates and so forth. And what you see with that is endless money printing, basically, and it's been concealed in terms of consumer prices by a lot of asset inflation, but you have an enormous amount of debt that's accumulated with this money printing, with things like quantitative easing. So, you know, the government thinks, and the Reserve Bank and central banks around the world think that they must meddle in the economy, they must keep interfering, therefore they must have policies to keep growth going, and that seems to always mean easy money, lots of spending, and lots of debt accumulation and credit growth. So, yeah, it's a long intro, but that means that somehow, I don't know how, inflation hasn't gone up until recently, except, of course, in asset prices. You've had the bull market of all time since 1981. We are interrupted at times, but you know, massive asset price inflation. House prices in Australia are a good example, but you've got crazy stuff like Bitcoin just because of easy money, people buying a banana for $6 million. It's called artwork. And so, you know, will inflation go away? Well, maybe temporarily the CPI will go down, but we have this problem of so much debt that cannot be repaid, and the best way to get rid of debt is to inflate out of it. For Australia specifically, you know, and just in terms of the short term, if I'm an economist, I'd pontificate about wage agreements and, you know, awards and things like that that make our inflation quite sticky. We are a services-based economy. We're exporting all our manufacturing jobs because we've decided we can't have any local cheap energy anymore, even though we sit on lots of it. And so we're a services economy, and yeah, we're very labor dependent. Those labor costs could keep our inflation higher.
Yeah. Okay. And how does that then impact the way you assess companies?
Well, you just have to take it into account. How do companies manage inflation? Obviously, their cost pressures are up, their wage pressures are up. You see in Woolworths, for example, you know, very broad-based exposure to the consumer. You know, and they've got to pay their employees more, and if they can't lift their sales by more than they're paying their employees, they go backwards.
Yep, it's as simple as that. Junbei, we're going to give you the next economic regime change now, and that's GDP growth. I know you're a fan of growth stocks, and GDP growth is obviously an important factor for them. Based on kind of your view and your own purview of things, you know, what shape is the Australian economy in, and does it get better or worse from here?
Yeah, so, well, first of all, before I answer that question, first of all, I'm going to say growth stock actually grow regardless of the GDP growth. But some may do, but a lot of them have structural tailwind. But let's go back to the Australian economy, and then we'll touch on that later. So, look, I think the Australian economy is actually doing okay. You know, yes, we've gone through the the consumer recession in the last 18 months, I think, quite long. And consumer has been struggling because cost of living and high inflation, we just talked to. Everything is expensive. I look at my parents, their purchasing power just smaller. So they've gone through a tough period. But regardless, we look at the corporate Australia, the margin is still doing pretty well, if not all-time high. They've gone through a bit of a tough period just in the more recent, probably 6 to 8 months. But, corporate Australia doing well, cashed up. We've seen a lot of M&A, and consumer seems to be coming out the other way. Seems to really started in July this year, and when, the announcement of the tax cut came through. Theoretically, it shouldn't have felt that fast, but consumers started spending from then. And it seems to be improving ever since. Now the inflation seems to be pick up, the shipping, I think, more particularly seems to have impacted a couple of outlook. But, our economy is still doing fine. Look at our banks, all-time high. CBA trading at more expensive than CSL. I think it's probably the most expensive bank in the world. Incredible bank, great bank, but it's very expensive. So it's just a sign our economy is doing very well. Economic outlook is good. And we just saw, I think this week we got our GDP data coming out, right? 0.4%, it should be acceleration. So we should start seeing our economy, trickle along here and, sort of stabilizing. Look, inflation is now trending the right way for us. So, it is heading down. I think 6 months ago, everyone's saying we're going to decouple from the rest of the world. We're not going to decouple. We were never going to decouple. It's just we thought there's a lot of, economists drawing straight lines. Global capital markets, very, very integrated. We all went through the inflation peak. Similarly, it's just our policy responded differently. And we have certain issues like the wages and others take longer to wash through. But they are on their way back. So, I do think these things are, playing in the background, and good to see our inflation is coming off. Our rate cut is coming, and that's good news for the share market investor. I'm a share market investor, and that's great to look forward to. Many say it's mid next year. I think it's early next year. And that will all add to a stable economy with a bit more loosening financial condition, and hopefully give a bit more confidence back to the consumer who's doing it a little bit tough. And then it's election year as well next year, so that usually it's quite stimulatory in terms of the promises, and others generally boost confidence. I know I talk a lot about the future, hope this is coming, that's coming. That's what share market is. We look forward 12 months, we want to see what is to come. We share market investors tend to be optimists, and we buy what future might bring, and I think outlook looks pretty good for the Australian share market.
Absolutely. Thank you, Junbei. Kirsty, Junbei mentioned a little bit there about interest rates, and I'm going to give you that particular question. I guess when I think of interest rates, I think of the policy response, but I also think of just the wild ride some of these interest rate sensitive sectors have had, right, over the last 2 years, particularly I think of REITs, tech stocks, the banks. I think when they write the recap of CBA at the ASX in 2024, it'll read, look at CBA go, and infrastructure and utilities as well. Kirsty, do you have any thoughts on, where rates should head, and I guess just as much, how much impact do changing rates have on the way you look at the market, if at all?
Okay, thank you, and thank you everyone for coming today. In terms of whether interest rates have any bearing on the way we invest personally, no, we are bottom-up investors. We look for companies with sustainable capital advantage, earnings growth, and valuation upside. In terms of the direction of rates, I think the market's pricing at the moment, one cut, 25 basis points between now and June next year. RBA has an interesting job ahead of it. As Junbei was talking to earlier, the consumer has been struggling. But generally speaking, we've got almost a two-speed consumer. We've got the retirees on one hand that have benefited from higher asset prices and higher interest rates in terms of the return on their savings. The other end, you've got the workers, the younger workers that tend to hold mortgages, or they're still paying rent, and that's all inflated. And so that's a cost of living crisis that's very real for that end of the economy. And you can see that in terms of consumption on a per capita basis, which has come off, yet total consumption in the economy has stayed at an absolute level at about the same level, and that's because we've had population growth. And this is the conundrum that the RBA has faced of late, is that you've got this gap between demand in the economy and the supply that the economy has, and that's quite inflationary. So I think part of the question was, is the RBA doing a good job?
Well, is the RBA doing a good job?
Yeah, well, I think taking, if you go back to Phil Lowe's comments a few years ago, which he probably regrets now, that we're not going to raise rates for a couple of years, I think the fact that they're taking a very data-driven approach now is probably the most appropriate way to go about it. Yeah.
Famous last words. They've gone from we won't raise rates for 4 years to anything can happen. We won't rule anything in or out. Let's move on from the economy and we'll move to public versus private markets. The ASX is shrinking. In the past financial year, 3 times more companies delisted from the ASX than IPO'd. We've lost names like Altium, Boral and CSR, to name a few. And a fund manager in Market Meters Research observed, and I quote, "I think this is why investors have been saying that the market is expensive. Meanwhile, valuations continue to grind up." So, Hugh, let me bring you back into the conversation. Is this something you are noticing as a stock picker, and I guess particularly from a concentration perspective as well?
Well, the truth is our market is one of the most concentrated in the world. I think there are some others like Korea with their chaebol, but to have 4 banks who basically are pretty much the same, although they have different colours and so on, and CBA is the best because they're the most expensive, etc. But that's 25% of our market, or give or take, all the time. I mean, that's extreme concentration. And you've had rising concentration in markets around the world, like the S&P, the top 10 is now at a record level, something like 35% of the S&P 500. So that's very concentrated. So that's part of the concentration is happening because of global things and market forces where the momentum stocks are doing well. So expensive stuff gets more expensive, underperforming stuff gets less. So yeah, you have quite a concentrated market. That's not an ideal thing for stock picking. Also lack of choice, because as you say, there's sort of fewer new companies coming to market, and the ones we've had recently, it's up to you whether you think burritos are good. But if you're a value manager, it hasn't been great pickings in the IPO space. So our job as a fund manager is to just find the best value we can at the quality that we require, and and we just have to deal with what's in the buffet in front of us, and sometimes that buffet is not as appealing as other times. The market's quite high, obviously you've got to look a little bit harder to find the tasty morsels.
I won't ask you if you're a fan of burritos here. Jumbe, over to you. I mean, you also look at global markets in addition to Australia. Is that a phenomenon you're seeing as well? Shrinking public markets, is it confined to Australia, or is the same thing happening offshore? And I guess if it is, then is it something investors need to A, worry about, and then B, adjust their allocations appropriately?
Look, I think it's happening around the world. And the reason it's happening is because, we think the public market is expensive. You look at the private market, they're far more expensive than public market. One of the reasons, we've driven such a high growth of the private market over the last, 2 decades is because, in the old days when people allocate money, right? So, it's 60-40, 60 to growth capital, so your share market, and then 40 into your fixed income. And that 60% over time has been, sort of shifted into the private equities, venture capital, the private markets, and they actually been the growth part of the thing. And the one good thing about that, in those for investor, is that it's not daily valuation, so you're not constantly being valued. Share market can be volatile, but they're not, because those assets, won't come into fruition until 3, 5, 10 years later. So, and then you can realize a lot of value. Now, the good thing is that it does create a lot of value, but the challenge is when the valuation valuation fundamental changes. For example, interest rate so much higher and inflation so much higher than we ever expected, share market reflect that straight away. So if not so more on the downside. So, share market gets sold off straight away. You see property trusts and everything trading at 30-40% discount straight away, even the A-grade premium offices, right? Whereas the private market, it doesn't get reflected, because you don't need to mark to market unless you're forced to do so. Maybe you do at the end of the year, or maybe if there's no transaction history, you don't need to do anything. So I think that's the challenge. So that's why you have this gap becoming larger and larger between private and then the listed market. So hence why the unlisted sort of peers, they see a lot of opportunity in the public market because they're so cheap. The valuation gap, we used to see in the private market, we see a valuation gap, but now we see in the listed market. Hence why we're seeing a lot of deals, company being taken private. So that's the one big driver. And second big driver is that I do think the regulations and impositions of a lot of requirement from listing is becoming harder and harder for the listed businesses. Especially for newer, younger businesses. The costs and others, and also the heavy requirement from investors, like your ESG policy and everything else. So some of those companies, they choose to stay private. I think that's, and then they got so much money, there's a lot of funding within private, right? So all these cash we heard sitting on the sidelines. So sort of keeping those companies private for longer. I think this dynamic will continue, but I think the challenge is it creates a problem when you don't have a strong secondary market. If secondary market remain to be cheap and discounted and remain to be illiquid, then it creates a problem for any of those private markets to then eventually realize those values. Someone needs to sell and find a marketplace. So I think over time becomes an issue. I think what we need is trying to create an environment where we do remove some of the regulatory burden, create transparency, but remove some of the burden for the companies to come through. And in Australia, quite frankly, we welcome all the growth companies. We want to see diversification, not just banks or resources. We want to see our growth company. And the good news is I have seen some of the little ones now coming through, which, we've got a very vibrant biotechnology sector. We've got a couple of other ones coming through. So that's good news. But yeah, well, it's ever developing.
All right, thank you, Jimbei. Kirsty, let me bring you back into the conversation. I appreciate you're a bottom-up stock picker, but what has your experience been with all this as well? And I guess where are you seeing capital flow, and how does that affect your opportunity set?
Yeah, it's interesting. My background is actually kind of infrastructure and transport, and I think that's been one of the key sectors that were targeted kind of more early on in terms of seeing some of our listed infrastructure names being taken out into the private space. And, I think that just plays into, I guess the listed market has a slightly short-term kind of focus on terms of cash flows, whereas the superannuation sector, which has been behind a lot of these privatisations, have a much longer term focus in terms of their investment horizon, which is more suited to the cash flows on the infrastructure assets, which are linked to population growth and inflation and the like. So we've seen that, and we've also seen some of the companies in the space take advantage of that appetite in terms of attracting co-investors into their portfolios. So Transurban would be one, but plenty of players in the listed property space do the same thing. So that's been our general experience. But the other thing I'd probably kind of point to is, eventually many of these companies that go into the private space kind of come back into the market, and we saw a raft of IPOs in 21 and 22 where the private equity was bringing these companies to the market and kind of taking everything for their investors and not leaving enough on the table for the listed market. At the end of the day, we have investors in our funds that need to see some return, and I'm referring to IPOs of things like Adore, Pexar, Lynch Group. As a general rule, kind of high valuations, a narrow focus around growth. Like their growth opportunity is more domestically focused, whereas you look to the PE opportunities globally, typically there's a much longer kind of runway to growth, and that would be more the sort of company we'd be looking for.
Okay, thank you very much. Let's move to our third megatrend now, if you like, and that's the ageing population. A fund manager participating in Market Meter's research felt that this particular economic thematic has created, and I quote, opportunities in healthcare, aged care, superannuation and travel, whereas the risks are in consumer spending amongst taxpayers, which wear that heavier burden, and I guess we put young people maybe in that category. So, team, and Kirsty, I'm going to pick things back up with you. How do you think about the ageing population thematic? And I was wondering as well, could you tell us about a couple of stocks that you and your portfolios might be exposed to with that theme in mind?
Yep, okay, I do have a couple of stocks. So the first stock I was going to point out today in terms of the ageing demographic is Cochlear, and it's not a company that you normally think of an ageing population when you first think of it. Historically, the growth has come from just putting implants basically into children, but now the majority of the growth for Cochlear is actually coming out of the adult segment. So about 70% of new implants are going into adults, and when you look deeper into that segment, about half of those are going into the over 65s, and that's growing at about 15% per annum. So as we live longer, as we're becoming more aware of the implications to broader health and mental well-being of being able to hear and participate in the environment around you, they have a lovely tailwind for growth. So we have Cochlear in the portfolio, and it plays nicely into that age demographic. The second stock I'd raise is Fisher and Paykel Healthcare. Again, not one you necessarily think about straight away as being a play into aged care. Generally speaking, their growth comes from changing clinical practice around nasal high flow oxygen, but a fair amount of their growth also comes from just the incidence of hospitalisations around COVID, flu and RSV each year, and as the population ages, as we live longer, there's going to be a bigger cohort of us getting unwell each year, and we quite like Fisher and Paykel for that thematic too.
Okay, thank you very much, Kirsty. Junbei, I'll direct this question to you. How do you think about the ageing population thematic? And as well, do you have a couple of stocks that you might be able to share with our audience?
Of course, look at aging demographic. Look at any trend that you can make money from, you should invest in it. And I think aging demographic is one of the key ones. You've got to have your portfolio. A couple of stocks. I'm thinking, Flight Centre. That's an interesting one because as people age, aging older demographic, as we have seen in our current economy, is that they're asset owners and they have far more discretionary income and spend. And what do they spend now? Quite a big portion of it they do spend on travel. Whereas the younger demographic is, does go through periods where high inflation gets high interest rate gets impacted more. So Flight Centre, the leisure travel actually has a higher skew to the older demographic. Even putting that aside, generally leisure travel is actually a very defensive sector. They grow year in, year out. Every now and then you have when you have exogenous event, whether it's 911 and others, you have a pause, or pandemic, you have a pause for a couple of years, but then you have that revenge travel. Especially people in Australia, we like to get out of Australia. We like to travel. That's right. We want to go to different places and we spend. So, so the travel is actually a big thing for Australians. And Flight Centre play well into that space and very much into also the packages and others. And it's, listed here and it's not super expensive. It's next 12 months is actually looking pretty rosy as well. So that one. And I want to also talk about Monash. Now I'm not sure if it's sitting in that aging, but maybe it's the other way. But Monash IVF. But in a way, it's that, people are having children later and later. So that's kind of my aging thesis. Having children later and later now, we are busy with career and others. So by the time, and then increasingly, there's more people worry about, worry about what's going to happen. So there's this increasing trend of frozen embryos and frozen eggs. So, so aside from increasing usage of IVF over time, it's actually that frozen trend is now picking up significantly around the world. Actually, around the world, it's in US, many corporates actually sponsor, pay their employee, for their first, for their cycle, for their frozen cycle. And in Australia, I think Google just launched it in Australia as well. So someone can confirm that. I read in the paper maybe 6 months ago. So this is a new trend, and that makes that company from being a cyclical company, because IVF is cyclical, economy a bit tough, it goes down and all that. Even though the company is being taking share, but still it is cyclical. But with that frozen cycle, now it's become a structural growth story because more and more people want to have the eggs frozen, and then you can, there's so many related increasing in spending related to that. So and that's just at the tipping points of that trend taking place.
All right, so we've had hearing aids in hospitals, we've had travel and IVF. This is a wild mix, everybody. Hugh, you get to take us home on this particular topic. How do you think about the ageing population thematic? And I'm curious to hear your couple of stocks that you're invested in with that in mind.
Well, I did think obviously travel, but I'm not sure I find Flight Centre that appealing personally. But so I sort of cast my mind over healthcare, and Sonic Healthcare could actually be, our next topic is artificial intelligence. You could actually talk about Sonic for that because they are using artificial intelligence for looking at radiology images and samples and things like cancers and so forth. It's a business that's grown over time. They've had quite a significant hiccup recently because thanks to the government's very generous funding of COVID testing and forcing or really imploring everyone to go and get tested even if they had no symptoms. Part of the reason why I've got so much government debt, wasted testing if you ask me, but anyway, Sonic made $1 billion, so that's pretty good for their balance sheet. They've been able to make some acquisitions, and over time those acquisitions will play out. So that's an investment idea around the aging population. As more old people get tested, older people get tested, all their cholesterol and so forth. The second pick I have is Medibank Private, which on the one hand you could say, oh, old people aren't so good because they go and claim all the time. Whereas Medibank actually is doing very well on claims at the moment. Their claims are very modest. And that's been the case since COVID, and I'm not sure what it is. I don't think people are necessarily healthier because there's still McDonald's is available on every corner. But what I like about Medibank is that they are doing a lot of self-help. They're not just collecting premiums and paying claims. They are trying to lower the cost of claims by doing things like rehab in the home. Their policyholders love it if they can go home rather than stay in the hospital, get rehab in the hospital. They can go and get treated at home. It costs much less for that, and so you will find that Medibank has been able to increase their margins a bit with that. And I'd much rather own them as an exposure to people having hip replacements than the hospitals, because the hospitals, they mostly got too much debt, but people are able to get a hip replacement, go straight home, or virtually maybe one night stay, whereas previously they stayed there much longer, getting rehab, getting nursing care, and so forth. So it's a nice trend that even though you might have more claims, you're managing them better.
Well, there may be a McDonald's on every street corner, but I'm curious what the audience thinks. I think there's a fishbowl now popping up on every second street corner as well, so maybe that balances out. Last topic, everybody, is AI, as Hugh has mentioned, and digital innovation. Here's a heat check on AI for you. One fund manager commented in Market Meter's research that, and I quote, "We are at the start of a large wave of investment and trial and error. Suppliers in the industry, think the tech majors, chip makers, data center providers, will be the largest beneficiaries, but many companies will benefit in a small way." So, Junbei, I'm going to direct this one to you as the beginning of our last topic. How important do you think this theme is, and how aggressively are you pursuing it, and with which stocks maybe as well?
Oh, absolutely. Look, I think I think that trend, that is the mega trend for the next few decades. I think we're at the beginning of it. At the moment, people are still talking about this trend as just chip makers and others. There's a whole supply chain that you can look for opportunities. And also, just from our perspective, day-to-day doing business, we can find so much efficiency. I actually find what's incredible about this AI, it's not just one or two sector, not just tech sector, not this. It's actually generally, you can apply that to every department of a business or any corporate. You should be able to find efficiencies utilizing the generative AI. So I think it's incredible, and even with the way it saves my time of doing different things, are just quite impressive. Actually, not recently, I just went to one of those presentation skill course, and then I met a couple of tech executive, and all of them have told me incredible stories about how they have number of AIs or does different roles for them. The executive coach, there's a counselor, there's just incredible, and the way they can adopt different format now. It's the speed and efficiency, just quite amazing. Put that aside, investment opportunity in the Australian market. You talk about the core. So the core ones we would like is the Goodman Group, right? So it is the greatest, one of the greatest property trust company in Australia or globally, and great execution, and now have this huge pipeline in terms of building out the data centers. It's not the pure play data center like the next DC, but it's far cheaper if you look at the pipeline that is coming through and the whole blue chip portfolio of clients. I think it's just incredible that you hold it. it in your portfolio, bottom drawer, and it will just compound growth for you. Another one is, actually that should be a core portfolio as well, is Pro Medicus. We held this company for many, many years, and this is the company people don't talk about benefit from AI, because imaging in radiology, and not just radiology, now they're going to cardiology and others, all these images, the implication of AI is significant. All the AI models are now utilizing the Pro Medicus software to train their software to be able to read or give second opinion about what is to come. So I think that's a huge space of opportunity, and that's currently not really priced in the share price. Share price is really about the growth in its core imaging business.
Yeah, and the feedback that I hear from people when they talk about Dr. Sam Huppert, who's the chief executive of Pro Medicus, one of those great founder operators. So good of you to bring that along. Thank you, Junbei. Kirsty, I'll direct this to you as well. How important do you think the AI theme is when you're investing, and how aggressively are you pursuing it?
Yeah, I think it's immensely important, actually. Kind of referencing the conversation we had earlier around inflation and growth. The answer to that, in a lot of ways, is productivity growth. And if AI can bring that to the broader economy, then I think we'll all benefit. And it is something completely new. I think I listened to the call for NVIDIA, and the last quarterly call. If anybody doesn't have the app Quarter, it's absolutely fantastic for catching up on calls that happen overnight. So the CEO of NVIDIA, what he just said is it's a completely new product, just like the iPhone was in the early 2000s. So we're going to have a whole raft of investment, and we'll find new applications and new ways to kind of drill into the data and find new products and services that leverage the economy. And we're not, we don't know yet what that will bring, but the opportunity is immense. Much like Junbei, the stock I'm bringing with me as an opportunity within that theme is Goodman Group. We held the stock for a little while now, and it's done very well for us. And like Junbei, the reason we're there is this, as an industrial property trust developer, they've got, I think it's a 35-year history in the space. It's a founder-led company. They don't have a lot of leverage. And instead of going out and speculating and competing against other players to find properties and data centre opportunities, they're mining their existing portfolio and they're putting it to the best and highest value use. And so we see that as a lower risk way to play the theme. As I kind of referenced earlier, we don't tend to buy speculative companies. We don't buy loss-making businesses, so we can't invest in something like a NextDC, and Lordy help us, definitely not GIDDY REIT. That's the next level again. So yeah, I'd recommend people have a look at Goodman.
All right then, thank you very much. Hugh, you get to bring us home. You started it, so we'll let you finish it. How important do you think the AI theme is? And again, how aggressively are you pursuing it?
As a rule, I don't like to invest on themes. Our firm is more bottom-up, so we don't just say, oh, let's find what we can invest in because it's AI exposed, because a lot of people do that, and that's how you get a lithium price of 10,000 that goes back down to 700 and something. People get too excited about saying and overprice it. And so, investment's about value, quality of the business and the value you pay for it. It's not just, oh, I've got to own this because of what the theme is. So we can't even begin to touch NextDC, for example. I mean, it makes no money. I'd love people to hazard, who don't actually know the answer, to hazard a guess at how much, given how much they're investing, how quickly they're growing. It must be like rocket growth, wouldn't it? And it's only, their revenue's only growing 10%, which is pretty unimpressive if you ask me. I mean, I'd rather own CSL, for example, growing about revenues at 13% or something, and it actually makes money, and cash flows and so on. So anyway, look, it is transformational potentially for a business, but I think for lots of businesses, and so I would choose to not play it through the obvious exposure. Well, you can't in Australia anyway. You can't own a chip maker. We don't have any, and so forth. But so I've picked two stocks that are just using technology or have a more,
kind of an adjacent play.
Adjacent exposure. So the first one I'd pick out is Orica, which has been for several years investing in mining technology. They're the world leader in blasting, and they have a digital division which has a number of companies, many of them acquired, that help the miners to lower their costs and become more efficient. Software that identifies where the ore body is, where the blast should go, where the ore will have ended up after the blast, so that the mining company only has to collect from that area where the ore is to take to the grinding and washing and what other mills that they have, and lower costs that way, and they share in the upside. So there's a huge amount of technology that they can use to make mining more efficient. The second one I'd pick out is perhaps a little bit more of an adjacency, which is Telstra. Now, Telstra is mostly a mobile business. They don't have their fixed business really the way it used to be. It's just a reseller of the awful NBN that we have in this country. Thanks to government intervention, not allowing the private sector to build it as they did in New Zealand, where Chorus offers 100 times the speed of the NBN, roughly speaking. Very rough. Anyway, but Telstra, what excites me about Telstra, and I don't think you're getting paid for it in the share price, because the share price is nothing like NextDC or Pro Medicus, is that they are building intercity fibre. They already have customers signed up, the hyperscalers, the Googles and the Microsoft, and these big tech companies need the data connections. And so they're building intercity fibre. I think they've 18 routes that will connect data centers up, and the huge demand for data means they'll earn a very good return. And it's just one of those ones where, as a value manager, you say, wow, okay, this could really add to their earnings over time. I don't think it's in the share price.
All right, we'll note all those ones down. Thank you, panel, very much. I thought we might leave time for a couple of questions from the audience if anybody is interested. By all means, if you do have a question, maybe stick your hand up. I don't know, Nick, have we got mics to go around? Oh, they're on the table. How do you like it? The audience is up here too. That's all right, thank you very much. We'll rove around, and anybody who wants to ask a question to the panel, I've got one over there, and we'll get going. Oh, sorry.
You mentioned the benefits of private markets, that they're not priced to market, but isn't that also a problem if you're not priced to market, and isn't that leading to issues further down the track that the super funds are finding out now? And I'd love to hear your comments on that. And then what's the impact of superannuation and the wealth that retirees have now, and has that changed the interest rate dynamic?
All right, thank you for that. We might start with the mark-to-market valuation of the private markets question. Who wanted to answer that?
Yeah, I'll answer that
Okay.
one. I was trying to be polite. I was just pointing out the benefit. And look, it does create a problem because it's not a real market, right? When you're holding up the valuation, when it's not a real valuation. We have seen that in the last few years. We've seen a lot of venture capital having to, very high profile devalue their assets. We've seen, private equity started going through that process of devaluing. So eventually value will converge. And I do think the opportunity, the value lies actually is in the listed market, because we reflect value so fast. And investors, as we said, sometimes short term, so it gives you the opportunity to generate the return in future years. So yeah, so it's definitely a problem. And now we're seeing that, moving into the private debt space is in the, so remember we said the 60-40, so 60 now we have the private equity going to the 60, and then we have the private debt going to the 40, challenging the traditional fixed income. And that is now very hot topic of, what that looks like, but it's similar sort of dynamic.
All right, and your second question was like superannuation interest rates, wasn't it?
Has the wealth that thank you. Thanks, Jonathan. Has the wealth that retirees have now in superannuation, has that changed the dynamic of interest rates? I mean, Australia's certainly never had that. I don't know if anywhere in the world's had the wealth generated by superannuation where retirees benefit from higher interest rates.
All right, thank you very much. Hugh or Kirsty, you want to have a crack at that?
I think Kirsty mentioned this. Yeah, you do have this thing where older people, not all older people, of course, I'm sure there's plenty of older people struggling, but some older people are doing well, so they're traveling more. Those European river cruises that are advertised in Judge Judy or something like that, I don't know, are booked out because the cruise line is all full, with pensioners queuing up for the buffet and so forth. So I mean,
How do we get back onto the buffet again?
Is it inflationary? Possibly. I mean, historically, the propensity to consume for older people was lower because they were sort of trying to eke out their savings for the the remaining term. They didn't need to buy furniture and stuff the way young people did. But, if you're very wealthy, of course, well, you might as well join the ski club, spend the kids' inheritance, and go off on cruises and travel and so forth.
Don't have too much to add to that, but I think one comment I'd make, and it's coming back to the RBA and the pace of rate cuts, or I guess the job that they have at hand, is if you've got a larger, older population with savings in hand, getting the economy to slow down during an inflationary period is more difficult when the higher rates are playing through to greater consumption. So that would be probably what I'd...
Yeah, no, absolutely. And you can see that if anybody ever delves deep into the CBA earnings report, that breakdown between consumers and how much they're spending and what they're spending on is pretty amazing reading, to be honest. If anybody has any other questions, you can stick your hand up now. I see no takers. I think we're all ready to go back to the buffet, I think is what I'm getting from this. Can we just say a massive thank you to Jumbe Liu, Tribeca, KIRSTY, MACKAY-FISHER of WaveStone, and HUGH GIDDY of IML. Thank you very much.